Trump taketh away. The post-election stock market ran further and further again, mostly because of the pretty plums Trump dangled in front of investors: tax cuts, deregulation, infrastructure. Until last month's correction, the overall market had swelled some 30% since that unforgettable night in November 2016. Has the president delivered the full cargo of goods and on the appointed schedule? No, we must acknowledge in fairness, he has not. But the methane swamps of Washington are vicious wastes, drowning most who hazard the passage. And you must admit this much if nothing else: the president was able to paddle his tax cuts through to a safe shore. Meantime, the agents we've assigned such matters inform us he has taken the presidential axe to hundreds of useless government regulations. Here, as far as markets go, Trump giveth. Ah, but the Trump that giveth is also the Trump that taketh. Trump shook the dust from his tariff blueprint earlier this month and unfurled it before a watching world. Under its terms, steel and aluminum competitors the world over would feel a good heart pinch upon entering American shores. Due to their volume of metallic exports, such perennial hellcats as Canada and Brazil would take the brunt. The Dow Jones Industrial plunged 420 points today. The news broke in for cause. Tariffs invite counter-tariffs. And markets believe a global trade war is bad for business. As we noted recently, Bloomberg Economics estimates a trade war could cost up to $470 billion in global GDP. Since the tariff unveiling, markets have been a seesaw affair, rising and falling at least in part on Mr. Trump's passing fancies. Trump dangles tariff exemptions before Canada and Mexico, and the stock market gets a bounce. He threatens universal tariffs unless the devils yield on NAFTA and stocks tumble. But yesterday, the president opened action against a new front in the global trade war. Trump vowed retaliatory action against Chinese thieves of American intellectual property. "We have a tremendous intellectual property theft problem," said the president. "Resolving it will make us a much stronger, much richer nation." It appears justice is with him. Estimates suggest Chinese piracy of U.S. intellectual property costs American business up to $600 billion per year. But markets are global citizens with loose attachments. Trade war is trade war, justice be damned. The Dow Jones plunged a ghastly 724 points on yesterday's trade news. After yesterday's trouncing, the Dow Jones occupied the same perch it occupied on November 28. It ended today another 424 frightened points lower. 4 months of overall gains have therefore vanished into the ether. Where once Trump giveth with tax cuts and deregulation, Trump now taketh with trade. Overnight, China's retaliation. $3 billion of American agricultural and steel products will confront 15-25% tariffs of their own. Anna Boada is the senior economist at trade credit insurer Euler Hermes. Ms. Boada estimates retaliatory Chinese tariffs could cost U.S. exporters up to $700 million. And so it goes. Are Trump's trade adventures solely responsible for the stock market volatility now upon us? No, they are not. Remember, the Federal Reserve is also at its tricks. Just Wednesday it raised its target rate yet again, the 6th occasion since December 2015. It is likewise chiseling its balance sheet. It is on schedule to shave $420 billion this year alone, $600 billion next year, and another $600 billion the year following. Mix the latest trade business with the monetary tightening, and a sour potion emerges. We fear markets might choke on the dose. Time, as is often said, will tell. Trump hath giveth, Trump hath taketh away. Which way does he go next? The Lord only knows. As you know by now, the Fed raised its target rate yesterday. I'll have more to say about that in the days ahead. But today I want to address some news that could have even larger ramifications for markets and the economy. The mainstream media haven't given it nearly the consideration it deserves. What am I talking about? President Trump announced plans today designed to punish China for stealing American intellectual property. The sanctions target China's high-tech sectors and place restrictions on Chinese investments in the U.S. See below for details. It will likely trigger Chinese retaliation and reignite fears of a global trade war. It was another bloodbath on Wall Street today, mostly because of the trade news. The Dow ended the day more than 700 points lower. This should come as no surprise. The stock market traded down when the trade war headlines first gained prominence early this month. That was when the Trump administration announced tariffs on imported steel and aluminum. Incidentally, these tariffs take effect tomorrow, March 23rd. Then stocks just as quickly bounced back on the view that Trump's bark was worse than his bite and that the tariffs and sanctions would be full of loopholes and exceptions. But that was just wishful thinking. It's true that Trump offered relief to Canada and Mexico on the steel tariffs, but that was only so he could gain negotiating leverage on the ongoing NAFTA talks. If Canada and Mexico failed to give Trump the concessions he wants on NAFTA, those steel tariffs can bounce back to hit Canada and Mexico, as they already hit China and Brazil. The bottom line is the world is now entering a trade war. This is something I've been warning about for at least a year. So it comes as no surprise to the readers of my newsletter, Project Prophecy, even though a lot of elites and Washington insiders were shocked when it happened. You must first understand that this is something Trump has been talking about for decades, going back to the 1980s. Trump has long talked about unfair trade, the importance of tariffs, the importance of creating jobs and protecting U.S. industries. This was the first thing he touched on when he announced his candidacy in 2015. He's never since varied in his position. So anyone surprised by his recent positions wasn't paying attention, was in denial or engaged in wishful thinking. But why didn't Trump announce these policies on day one? Well, the answer is he wanted to. But there were constraints. The biggest single constraint had to do with North Korea. A marginal economy always on the brink of collapse, North Korea depends upon the economic support of China. Trump therefore hoped he'd limit North Korea's nuclear ambitions by convincing China to withdraw economic support if North Korea persisted in developing nuclear weapons. These efforts mostly failed. In the first place, North Korea considers nuclear weapons critical to its survival and was never going to completely abandon its program. It sees that America has only attacked countries that did not have nuclear weapons, like Iraq and Libya. It fears a similar fate if it doesn't develop its own nukes. Secondly, China did very little to curb North Korea's nuclear program. But this should not have been surprising. North Korea is a thorn in America's side. And Beijing doesn't want to help the U.S. remove it. North Korea directly borders China. And China fears a united Korean peninsula under the sway of South Korea and, by extension, the U.S. Why would China strengthen the American bargaining position? Now Trump is taking the gloves off. And the trade war is finally here. But the tariffs on steel, aluminum and solar panels are child's play compared with the mother of all trade sanctions. This is coming soon in the form of a report that will land on the president's desk any day. Read on to learn all about it. That's when the Federal Open Market Committee, FOMC, the Fed's interest rate policy arm, will raise interest rates another 0.25%, the sixth such rate increase since the liftoff in interest rates in December 2015. This is the most aggressive tempo of rate hikes of any major central bank and puts U.S. policy rates significantly higher than those in the UK, Japan or Eurozone. The issue for investors is whether the Fed is raising rates too aggressively considering the strength of the U.S. economy. Higher rates imply a stronger dollar, imported deflation and headwinds to growth. If the U.S. economy is on a firm footing, then the rate hikes may be appropriate, even necessary to head off inflation. But if the U.S. economy is vulnerable, then the Fed's actions could trigger a recession and stock market sell-off unless the Fed reverses course quickly. My view is that the latter is more likely. The Fed is tightening into weakness and will reverse course by pausing rate hikes later this year. When that happens, important trends in stocks, bonds, currencies and gold will be thrown into reverse. Investors who position now for a coming course correction by the Fed can reap huge gains when that Fed flip-flop occurs. Outwardly, the Fed is sanguine about the prospects for monetary normalization. Both Janet Yellen and new Fed Chair Jay Powell have said that interest rate hikes will be steady and gradual. In practice, this means 4 rate hikes per year, 0.25% each, every March, June, September and December, with occasional pauses prompted by strong signs of disinflation, disorderly markets or diminution in job creation. Balance sheet normalization is even more on autopilot than rate hikes. The Fed will not dump its securities holdings. Instead, it refrains from rolling over maturing securities. When the Treasury pays the Fed upon the maturity of a Treasury note, the money simply disappears. This is the opposite of money printing, it's money destruction. Instead of QE, we now have QT, or quantitative tightening. The Fed has been transparent about the rate at which they will run off their balance sheet this way, although transparency should not lead investors to complacency. The balance sheet reduction tempo as of late 2018 is $600 billion per year, equal an impact of 0.25% rate hikes per year. The annual combined impact of the Fed's rate policy and QT is a 2% increase in interest rates. For an economy addicted to cheap money, this is like going cold turkey. The Fed would have investors believe that the rate hikes are already priced into capital markets, and QT is a non-event, running on background, in the Fed's words, like an Excel spreadsheet on your laptop while you watch a film from Netflix. Neither assumption is correct. The view that balance sheet normalization can run on background without disruptive effects is unwarranted. The Fed printed almost $4 trillion of new money over 6 years from 2008 to 2014 to inflate the value of risky assets. Yet somehow, the Fed would have investors believe that destroying $2 trillion in even less time will have no negative impact on the value of those same risky assets. It's not true. Below, I show you how the Fed could be making the same mistakes it made in 1928 and 1937, which led to and prolonged the Great Depression. Americans' economic hopes strongest since 2002 on Trump tax cuts. Americans' outlook for the economy climbed in March for a third straight month to match the highest level since 2002, data from the Bloomberg Consumer Comfort Index showed Thursday. Highlights of consumer comfort week ended March 18. Monthly gauge of economic expectations increased to 56 from 54.5. 39% of respondents said economy getting better, the biggest share since March 2002 and up from 38% a month earlier. Was 30% in December. Weekly consumer comfort index advanced to 56.8 from 56.2. Personal finances gauge rose to 62.9 last week, the second highest level since May 2007, from 62.1. Key takeaways: resilient hiring and more take-home pay in the wake of reduced taxes are generating more optimism about the economy. The tight labor market has been keeping weekly consumer comfort elevated as Americans feel more secure in their jobs. A February surge in payrolls as the jobless rate held at 4.1% signals the labor market still has room to grow before it reaches full employment. While the pickup in sentiment this year hasn't been accompanied by stronger household purchases, sustained optimism and faster income growth may allow spending to accelerate in coming months. Other details: the weekly index measuring current views of the national economy improved to 59.7 from 59.1. Weekly buying climate gauge rose to 47.8 from 47.3. Share of respondents who say economy is getting worse decreased to 25%. The lowest since April 2017. Economic expectations vary greatly by party identification, with 75% of Republicans seeing improvement compared with 18% of Democrats. Consumer comfort among married Americans matched highest since 2014. Months into the current administration, CNN anchor Erin Burnett felt compelled to make a startling admission: Donald Trump may go down as a great president. She added, "And there's no way around that. That is the reality here." Burnett's assessment was referring to President Trump's ability to get the North Korean dictator to the negotiating table and solve the 70-year-old problem with the communist regime. But there is another factor already pushing Trump into the greatness pantheon: the economy. The first 3 quarters of Trump's presidency have been tabulated and GDP growth comes in at about 3%. The magnitude of this result becomes clearer when one realizes President Obama averaged GDP growth of about 1.5%, so low it is considered near recessionary. Shockingly, Barack Obama is the first U.S. president since the Great Depression to never see a 3% GDP rate in any year of his presidency. In a short time, Trump has jumped economic growth by almost 100%. This is the really big story of the Trump presidency you have never heard on the nightly news. Trump critics are quick to deride him and take away the credit he deserves. They tell me he inherited this as a gift from Obama. How so? I ask. I usually get shrugged shoulders. Trump indeed drove economic growth last year. There was a massive deregulation program, backing the Keystone Pipeline, and we're drilling, opening liquefied natural gas exports, and bringing in over $500 billion in foreign investment and purchasing deals, all while delivering on a massive business and personal tax cut. The media harps on his alt-right base, but misses his real base: small business people, entrepreneurs, and corporate America. This business class love Trump and see him as one of their own in the Oval Office. We see evidence of their support in record business confidence numbers, including Gallup's Small Business Confidence Index hitting records. Make no mistake about it, Trump has created a new version of the presidency. I call it Trump 3.0. Typically a 2.0 version updates the original. But 3.0 breaks all the molds. Coincidentally, 3.0 matches that high GDP growth rate President Trump has been overseeing. A few weeks ago, I mentioned to the president that his presidency is Trump 3.0. He liked the idea, but quickly added, it's going to be 4.0, and then 5.0 very soon, you'll see. Always striving and relentless, Trump indicated to me he wants 4 to 5% GDP growth rates. Most establishment economists scoff at such a goal. But Trump has a soulmate in Larry Kudlow, his new chairman of the National Economic Council. Kudlow, one of the country's most respected macroeconomists, was a key architect of Reagan's economic program, one that gave the U.S. hyper-GDP growth in the 1980s, reaching over 7% annual growth one year. Kudlow tells me Trump's prediction of 4 and 5% GDP rates is not off. These benchmarks will be reached, he says. So, forget the smokescreens the major media are pushing on the American people on a constant basis, not stories like Russian collusion and Stormy Daniels. The big story is about the economic miracle ignited by President Trump. In journalism, we have always been counseled to follow the money. Well, you should too and make your own judgment about the president.
Cryptocurrency News Channel. Your new future. Thank you. Follow us on YouTube.